Hey guys, welcome to Money Mindset and More. And today's quick discussion is on what is acquisition in business. While it is a fairly complex process, I will try to explain in this short video. Uh, Acquisition in business is when one company purchases another company either by buying their assets, their stocks, or equity. And ultimately, the company which is purchasing the other company become the overall controlling entity. And there are certain key aspects of acquisition, why companies do that and things like that, that I will cover as well. Most important aspect is that they want to have control and ownership of a particular company, which might be a complementary to the existing business of the acquiring company, or it might be a competing business which they want to acquire and create a pseudo or monopoly or something like that. There are three main types of acquisitions which normally you can see in the market. One is when the company buy the asset of other companies. Examples are like Bed Bath and Beyond. When it went bankrupt, Overstock only bought their .com domain by paying $6 million. That is called asset-based acquisitions. Then you have stock-based acquisitions where you either buy majority of stock from the open market, or you buy stocks from the any majority stockholders, or you start accumulating smaller portion of stock in the free market, and subsequently you have become a majority stock owner. And the last one is mostly either hostile or friendly acquisition, where the other company doesn't want to get acquired, but you will see that other companies are pushing from different angles to get it acquired. LTI Mindtree is a classic example where LTI has done a hostile takeover of Mindtree. Now, why companies do that? You need to understand that as well. The most important aspect is that market expansions. Companies sees that, let's say somebody is operating in US and they want to start an operations in India. Sometimes it is far easier and better to get expansion in the market by acquiring a local company which is already established. That way you don't have to build sales and operations, distributions, and other channels of delivering to customers. Then also sometimes you get access to the resources. So for example, if you are a oil refining company and you want to acquire a oil drilling company, so basically you are acquiring an asset where you are going to use those resources to build up your own refinery business. Reliance has done similar things in Saudi Arabia, for example, and Ramco, which is a Saudi Arabian company, has done in Reliance. So vice versa. Both have stakes in each other. Then another concept is economies of scale. Considering a lot of costs are getting involved, lot of because of a lot of regulations, better cost of living, employee costs are getting higher and higher day by day. Economies of scale is very much important for the acquisitions. So companies like United Airlines and Continental Airlines, US Airways, United Airlines, and then obviously other, you can see other examples in different industries. Because of the cost pressure, these industries sees that okay, it's better to merge the operations to get the economies of scale. Otherwise, both companies might go bankrupt in the long run. Some of the aspect is also on the eliminating the competition. If you see in case of Google, they acquired YouTube probably 10-15 years ago, and they saw YouTube as a de facto search engine for video and testing contents in future, which will be a threat to Google's search engine, as that is their main business. Also, they were trying to see how they can generate another revenue stream, which is the ads revenue, and YouTube might have a better opportunity because of the video content. So they acquired that company. I would consider that as eliminating competition, and that's why you can see Google has a monopoly of search engine content. They have threatened by ChatGPT and others in current scenario, but still, as far as the search content goes, Google is still the best one. Also, you have to see how these deals have been structured. They are sometimes cash based, they are sometimes stock based, or it can be mixed up both. You must have seen that X company has acquired a Y company for cash and stock based price. So what they normally do, they give certain portion of the valuation as cash, and rest they mark up or give a premium on their current stock price, and then offer the similar stock of their own company. So it can be something like, if let's say Walmart buys a company which is smaller, they will give some cash amount, and then they can give a premium on the stock price of the company which they are acquiring, or they can give an equivalent Walmart share to the stakeholders or shareholders. So there are many permutation and combination which works in that scenarios, but overall it is a very complex process. And as we are getting matured and in a lot of interference from AI, this is you will be going to see a lot of acquisitions in coming years in every industry. That's how you can survive, and all the smaller companies will have a lot of challenges in scaling. That's why this is something which you need to understand if you are planning to start a business, or you are already running a small business. And if you see the right opportunity to get acquired, you should always consider it. That's what I feel. So this is for today's video. Most probably I'll cover some more interesting topics tomorrow. Please like, share, and subscribe. And thanks for your support. Thank you. Bye bye.